Hello, hello, hello. Okay, we're going to take a look at Chapter 16 this week. Chapter 16 talks all about financial statement analysis. This is something that managers do all the time. Now, when I started, every company that I ever started with, one of the first things I did was set up a series of income statements in a spreadsheet. So maybe 3 years, 5 years, so I could see if there were any trends. Were there any interesting problems happening with revenue, for instance? Was it really high one year? Why? See, these kinds of analyses don't give us answers, but what they do is they give us questions, things to think about. Maybe there's a problem, maybe there's not. So we're looking here at this comparative balance sheet for Clover Corporation. What do we see? Well, we see a 49% decline in cash from last year to this year. We see a 50% increase in accounts receivable. Well, could that be connected? Maybe. Maybe if we're not collecting receivables fast enough, we're not getting cash in, so we're depleting our cash account. Could be. We're guessing, obviously. This company doesn't even exist. So we're kind of making it up as we go along. Inventory. Prepaid expenses are up 150%. If I own the company, what am I saying? I'm saying why. That's all. Just why. Let's dig deeper into it. We increase, obviously, if I'm the owner of the company, I know why we spent $35,000 on buildings and equipment. We obviously bought something. Now, looking at the income statement side, what do we see? Well, we see an 8.3% increase in sales, but a 14.3% increase in COGS. That brings a question to my mind. These should be pretty close, shouldn't they? And then we look at our gross margin, and of course, because COGS is so much higher, we had a 3% decline in gross margin, even though we had an 8.3% increase in sales. This is not good. This is something we want to look at. Look at operating expenses. All right, so they're up 2%. No big deal. I'm not seeing that as an issue. Interest expense went down, so I'm guessing maybe we paid off loans, which also could be affecting that cash from the previous screen. Income taxes obviously are less because net income before taxes are less. The bottom line here is, the real bottom line, a 21.9% decrease in net income, even though we had an increase in sales. So I'm thinking we've got some work to do. And what we're looking at here also are trends. Are things changing over time, and what and why? Trend percentage takes the current year amount divided by a base year. And we're going to do that on the next screen. So the base year is going to be year 1. And looking at year 2, let's see, year 2 we have $290,000 in sales, $275,000 in year 1. So times 100%. So we have 105% in year 2 of sales, meaning it went up 5%. That's good. And we see that COGS went up 4%. So that's kind of okay. So COGS went up a little bit less than sales did. And of course, that means that we have a gross margin that went up 8%, and that's always good. But do we see anything else in years 3, 4, and 5 that we need to be concerned about? Well, what happened in year 3? COGS is now higher than sales. And it's again higher than sales here. And again in year 5. So COGS is going up much faster than sales. This is not good. So we need to find out why. And they're saying it here. We can see that cost of goods sold is increasing faster than sales, which is slowing the increase, obviously, in gross margin. Now here we're looking at common size percentages. So we're saying that Sales is 100%, and we're looking at everything else here that's a percentage of sales. So COGS was 65.6% last year. It's 69.2% this year. So COGS went up, which means, of course, that our gross margin is going to go down. Notice, even though sales went up, gross margin went down. Operating expenses, pretty much the same. Net operating income, there's the interest expense. So the thing that we want to look at here, what happened to COGS? And think, while you're thinking about this, what could you do to fix that cost of goods sold program? Maybe one thing would be to go out and look for a new supplier. Okay, so the first ratios we're going to look at are the liquidity ratios. And you'll remember from 201 when we talked about liquidity, remember we talked about the assets being listed in order of liquidity, right? Cash being the first. The definition of liquidity means how easy is it to turn it into cash. So first thing we're going to look at, working capital. Working capital is basically if you cashed in all your current assets and paid all your current liabilities, would there be anything left? In this case, yeah, we'd have 23 grand. That's working capital. That's money that you can use for a variety of resources, for a variety of projects. The second ratio we're going to look at is the current ratio. This is a very popular ratio. This essentially says, can you meet your current liabilities? So we take current assets divided by current liabilities. In this case, 65,000 divided by 42 gives us a current ratio of 1.55. Now, any current ratio over 1 is good. The question becomes, is 1.55 good for this industry? And the only way you know if that's good is if you go out and find a comparative current ratio for the industry or for other companies in the industry. So then you can compare the two and say, okay, ours looks good because that looks okay. But if I told you that for the professional service companies that I worked for, we typically had a current ratio of 4 or 5. So if I went to my boss and I said, we have the current ratio for this month is 1, or to year to date is 1.55, I would get reamed out. So this number, this one ratio, and any one ratio doesn't tell you anything. You need to be able to compare it to something else. And the acid test is similar to current ratio, but it only uses cash and cash equivalents. The big thing it leaves out with regards to a merchandising company is inventory. Not included here. So the quick asset or the acid test ratio is much stricter, which means it's going to be a lower number. In this case, our quick assets are 50,000, current liabilities are 42. So we have an acid test ratio that's still over 1. That's a good thing. That's a good thing. Okay, accounts receivable turnover. So what this says is, how many times in the year did we completely collect accounts receivable? Obviously, the bigger the number, the better, right? Because we want to collect receivables fast. We turn them into cash, and that way we can give dividends and we can pay our bills. So here we've got $494,000 in sales on account only, not sales in cash. And then we have beginning receivables, 17,000. Ending receivables, 20 divided by 2. And that gives us 26.7 times. That's our accounts receivable turnover. So we have turned over or collected receivables 26.7 times for the year. Now we use that number to find an even more important number, one that I used in collections all the time. The average collection period. What this says is, what's the average time it takes you to collect your receivables? Well, we divide the receivable turnover into 365, and we get 13.67 days. So what this says is, on average, it takes 13, almost 14 days, 2 weeks, to collect an account receivable. I worked for a company years ago that I had to fix because their average collection period was 111 days. Yeah, bad number. Inventory turnover, similar concept to accounts receivable turnover. Measures how many times a company's inventory has been sold and replaced during the year. So we had COGS of 140,000. We have an average inventory of 10 plus 12 is 22, divided by 2 is 11. So $140,000 divided by 11, we have an inventory turnover of 12.73. And we're going to use that similarly to what we did with the AR turnover number. We're going to go look for an average sale period. On average, how long does it take us to sell the entire inventory? So we take the turnover divided into 365, and for this company, we have 28.67 days. So about a month to completely sell the inventory. Asset turnover. What does that mean? We're comparing sales with the average total assets. So how well is the company using the investment in the assets to create sales? We've got sales of 494. You guys can work this out, but we've got an asset turnover of 1.53. Problem here is, again, we don't have anything to compare it to. You may want to just compare this to previous year's asset turnover numbers and see if the company is maintaining, if it's getting better. Times interest earned. This is an interesting one. Most common measure of a company's ability to provide protection for its long-term creditors. So what we're doing here is we're taking earnings before interest and income taxes. In the accounting world, it's called the EBITDA number. Earnings before interest, taxes, depreciation, and amortization. We're taking that number and dividing it by interest expense. So what we're saying here is we're taking how many times can the earnings pay the interest? Obviously, the larger the number, the better. 11.5 times for this company. Debt to equity. Debt to equity indicates the relative proportions of debt to equity on a company's balance sheet. So how much is financed and how much is paid for by the owners. And here we're talking 0.48. That's a pretty good number. Gross margin ratio, we've seen a lot. Gross margin percentage. We did that in Chapter 4 from 201. The gross margin divided by sales. So in this case, 71.6. What that means is that after we pay for COGS, we have 71.6% of the sales left to pay for expenses and profit. Net profit margin, this is the bottom line number, right? This is taking net profit, 53,690, divided by sales. Net income, rather, divided by sales. So we have a 10.9% net profit percentage. That's not bad. But again, depends on the company, depends on the industry. If I went to my last boss with a 10.9% profit margin, she would say, "Are you crazy?" Because we ran about 25%. So again, I can't stress this enough. Ratios are good, but they're only as good as your ability to compare them to something else, to a benchmark, if you will. Return on total assets. So we're taking the net income, plus we're adding back the interest expense, the tax on interest expense, divided by average total assets. So in this case, we had net income of 53,690. We had interest expense of 7,300. We're multiplying that times 1 minus 0.3, which is the tax rate, or 0.7, divided by the average total assets, and we have a return on assets of 18.19. Adding interest back to net income enables the return on assets to be compared for companies with different amounts of debt. Return on equity. So the stockholders put money into the company. They have an investment in the company. What's their return? Well, we had net income of $53,690 divided by the average stockholders' equity, and the return on equity is 25.91%. Indicates how well the company used the owner's investments to earn income. 26%, pretty good. Wouldn't mind getting a 26% return. The definition of financial leverage. It's the difference between what the company has to pay to borrow money or get money from creditors and what the investment is going to return. If the return on the investment in the assets is greater than the fixed rate of return for borrowing money, then there's a positive financial leverage. Obviously, you're making more money on the investment than it cost you to borrow the money. If you have the reverse, return on investment in assets is less than the fixed rate of return on the borrowed funds, you then have negative financial leverage. EPS, you all talked about this in the Champion Wave project in 201. Earnings per share, we take the profits or the net income, divide by the outstanding common shares. That tells us how much earnings for each share that's owned. In this case, it was $2.42. PE ratio, again, something we used in Champion Wave. Price earnings. We're taking the market price per share and comparing it to earnings per share. And earnings per share, remember, we calculated here. So the price per share is 20 bucks. Earnings per share is $2.42. So our PE ratio is 8.26. Now the PE ratio is driven mostly by this market price. And what does the market price tell us? Well, the higher the market price, the more convinced investors are that the company over the long term is going to be profitable and increase in revenue. Dividend payout. So the dividend payout ratio gauges the portion of current earnings being paid out in dividends. Obviously, investors, besides looking for an increase in the share price, they're also looking for dividends, a partial distribution of the profits. So dividends per share divided by earnings per share gives us the payout ratio. The dividends per share in this case are $2. The earnings per share were $2.42, so the company's paying out 82.6% of the earnings as dividends. Now, dividend yield ratio identifies the return in terms of cash dividends on the current market price. So we're taking the dividends per share, again, we got that $2, the market price per share, 20, and dividing this. So the dividend yield ratio is 10%. That's the 10% return on the current market price per share. Book value per share does not equal the market value per share of 20. This is because the market price reflects expectations, just like we talked about. So we're going to take the common stockholders' equity, $234,390, divide it by the number of common shares outstanding, and we get $8.55 per share. That's the book value. And that's a brief look at Chapter 16. Please feel free to contact me if you have any questions. I'm always available. Have a great week.